Hi everyone, a short video for you to discuss the first quarter analysis of our Navigate portfolios and a couple of areas I've highlighted just to discuss with you now. So the report and analysis is provided to us by Betafolio. As a reminder, Betafolio are the independent team of investment consultants that we selected to first help us build the Navigate portfolio range, and they provide regulatory oversight of the portfolios and also ongoing analysis. And as a team, we meet with them at least once a year to discuss any changes that within the portfolios that we feel might be appropriate. But also they're on hand to answer any technical questions we may have about the portfolio or about anything that's happening within markets overall. So it's no surprise that Daniel begins by talking about the geopolitical risk in Ukraine. But one thing he touches on here is that the historical significance of global conflict in terms of how markets have performed, looking at things like the Second World War, looking at things like the Iraq War, it's actually the periods in peacetime that have seen the most significant market drops. So whilst it's a miserable time for those involved within the conflict, if you're concerned about the implications for your portfolio, the biggest dips have actually occurred outside of when there's been significant global conflict taking place. Daniel then goes on to provide a bit of backdrop as to the economic impact, significant clearly in the drop in GDP in Russia, even more so in Ukraine, and how this will filter into the global economy, predominantly an energy story, but also because of the amount of food that Russia and Ukraine produce. That's clearly both connected to each other, likely to have a very significant impact on things like the supply side of global distribution and also inflation. Key for Europe is going to be the way in which Europe has now become quite dependent, and I think history will show this was a deliberate act over the last decade of Russia to tilt its economy towards energy, so that first of all Western sanctions had less of an impact, but that future sanctions would have less of an impact. And obviously this is causing issues for countries like Germany, who are very reliant on Russian energy. And we've seen European countries such as Lithuania have already moved away from energy supplies from Russia, but it's going to take time for larger economies to do so, and that's discussed here. He then goes on to conclude about whether this is a good time or a safe time invest, and a key point here being that the S&P dropped 9.5 at the start of the pandemic, and although it would be natural to want to miss that, it then there was a tremendous rebound from about March to June 2020, all of which would have been missed had anybody avoided that period, but also highlighting the fact that this was outside of a period where there was the conflict was taking place. So just to conclude and to touch on our portfolios, whilst it's been a difficult start to the year and an unusual start to the year, because typically where there is turmoil in markets, you'll see the portfolios that are less volatile normally show a lower or a lesser decline. But because the drops have occurred, or the reduction in value have occurred in the bond markets, this has meant that our more cautious investors are seeing, I expect, a short period of time where their portfolios are showing greater declines than clients who are willing to take or willing to receive high levels of volatility in normal times for a greater level of return. So whilst we see through the Navigate range greater declines now, if we take a look at the calendar performance. I just want to highlight one period here. So this is the performance of the portfolios in 2018, and a -4% for that year looks relatively benign. But in 2018, I had lots of meetings with clients who were very anxious because the S&P in October that year dropped 20%, just under 20%. And in the August before that, Bitcoin fell 45%. And the reason the market or the equity markets fell so sharply was due to the concerns that Trump and China would have a prolonged trade war, which never quite materialized. But the concerns then were that we would enter a global recession, and whereas in fact the markets then recovered quite significantly towards the end of the year, posting a -4%. But it doesn't tell the true story, and almost everybody will have forgotten, I suspect, the concern logging on, looking at portfolios in 2018. So the first is that the volatility we've seen recently in markets relative to the past it isn't significant, comparatively so. And when we see a decline in markets, it's not unusual to see then a very significant rebound in the following year. And therefore, if the markets decline this year, it's quite possible that we'll see greater returns. But really what this means is, and my final point, is that the annualized rate of return, if you look at let's take Navigate 60, if you look at the annualized rate of return over 3 years, 8%, 5 years, 7%, and over 7 years, 8%, I would say historically this is probably maybe 2% higher than the average rate of return that you would expect for Navigate 60. And if we have a period of lower returns next year, then this will be really just reversion to the mean, the average rate of return within the portfolio. And the most important thing to consider there is where these numbers sit within your wealth map planning. So when we've got a series of objectives planned in your wealth map figures, is to look at how the long-term rate of return is affected and whether you're still on track. And I suspect you are, unless you're one of our new investors, and in which case you're experiencing an absolute loss based on that period. And all that it's going to take is for future higher rates of return to bring you back alongside the expected rate of return for your portfolio performance. But if you've been with us for a while, then the recent volatility is going to be offset by the profit that's been made and is held within the account in the previous years. Let's take Navigate 60 now, 16, 9, 11 historically. So whilst we are clearly concerned for those involved in Ukraine, and it's a miserable period for those out there, the ramifications for your portfolio are likely that we will see a return to positive markets, maybe towards the back end of this year, maybe next year. But all we need to do, and this holds for me also, is to remain patient, and normal service will soon resume.